there, I'm Don Davis. I'm a securities lawyer. I've been doing it a long time, and this is a series of videos talking about some of the things I've learned over 45 years of practice that I hope can help you. The last video we talked about debt as a form of capital investment into your company, and today we're going to talk about straight common stock equity. No warrants, no options, no common stock, no this, no that, the other. Just a plain old equity deal. You need money, you sell common stock in your company, you get the money, and off you go. Sounds pretty simple, right? Well, of course, nothing's very simple these days in the securities laws or anywhere else. But anyway, let's talk about this for a minute. The first and most important issue to you is, well, how much money do I get, and what's the price of the stock? Everybody asks me, well, what's the price of the stock? Well, my answer is, I don't know the price, you got to tell me. Because the price is a calculation of two things you've got to tell me. How much money do you need to build your business to the next level? How much money do you need? If I write a check right now, how much do you want? And second, and equally important for you, what percentage of your company are you going to give to me, the investor, for writing that check? You don't want to give too much, you'd be giving points away. But if you don't offer enough, well, the investor's not going to write the check, and so then we're just chasing our tail. So what you need to do is calculate those two things first. If we take those two issues, first, how much money you need, second, how much you're going to give away of your company for the money, and then we take a third issue, our third fact, which is how many shares you have outstanding. It's an easy calculation to determine exactly what the price per share should be, and that's what we'll use. So that's the first formula I have to worry about. And as I say, you can't be too much because you don't want to give points away, but you can't be too stingy or no one's going to want to invest. So you got to figure that out, and we're here to help you with that. We see deals all over the country, all of the time, and we have a good feel for what's motivating people to write checks. And I'm happy to talk to you for 15 minutes, just off the record, if you like, about pricing your deal to give you what I think based on the experience we have around the country. So, first issue. Second issue, and that's the thing the investor's going to ask as his second question. If he likes your business proposition, he likes the business, he's interested, he likes you, how do I get my money back? Okay, I'll give you the check, Mr. Company Owner. I like the percentage you're going to give me for the check. It all sounds fair, but how do I get out? I'll tell you, ownership of a minority equity common stock position in a privately held company with no exit strategy is worth about zip. I know that. You know that. The investor knows that. Investors aren't dumb these days. They understand that's the second knee-jerk question they're going to ask. How do I get out? So we have to answer that question. Well, there's lots of ways of getting out. First, maybe you want to take your company public, and we do that a lot. We take a lot of companies public into the pink sheets, the bulletin board, the American Stock Exchange, or higher. If we go public, then the investor can sell his shares in the market to some other shareholder. He gets his cash back. He can sell part of it and keep part of it. He can do whatever he wants, but he's got an exit strategy. So that's an excellent way of doing it. Another way of solving that question or answering that question is to say, well, we're going to sell the business to another really large company in the business, in our industry, maybe for cash, maybe for publicly traded stock, maybe for a combination of securities, who knows. But that's how we're going to get out. That's how we're going to get your money. And investors will buy into that too if they believe that you've got a significant company and it will be snapped up because it's such a great company. It's small, but the leaders in the industry are going to need the company as you build it, and they will snap it up. And we've seen lots of deals like that. Finally, there are various other ways of answering that question for the investor. What option is to pay dividends? Well, Mr. Investor, this is common stock, but we're going to pay a dividend. We're going to give you a dividend every year of X% of the value of your investment. And so you have a stream of incomes. And perhaps if we don't pay the dividend, we miss it, and it will accrue, so we owe it to you. Maybe it accrues for too long. Maybe you need a seat in the board or some other option to get your exit strategy in place. But we'll figure out a way to get your money back to you. We'll answer that question. There are other options as well. There's a put. Mr. Investor will give you the right to put the stock back, and we'll have to buy it on a set schedule all at once, or maybe over a period of years, or whatever we work out. Another excellent way to answer the question. But those are the two questions you have to answer for the investor. First, what's the price and how much do I get? And second, what's the exit strategy? Hope this little video has been helpful, and we'll have some more in the future. I'm Don Davis. I'm a securities lawyer. I've been doing this for 45 years. I'd love to talk to you. I'd love to hear about your company. My telephone number is 213-400-2007. 213-400-2007. It's only a 15-minute call is free. On the house, I want to hear about your business and what you're doing. Thanks.